this is a reading all about really two things really, bonds and leases. So if you're studying the readings through the CFA syllabus and everything, you'll know that there's questions at the end of each reading. In terms of how many questions there are, well, in the curriculum readings, you will find that there are approximately 16 questions at the back of this reading. Now, actually, for FRA, that's actually not a huge amount of questions. The questions also as well are not massively computational, i.e. not all 16 of them require you to produce numbers. Quite a lot of them are qualitative questions. So it's absolutely important that you understand not just the numbers, but also any of the words that go alongside this, because there is a variety of learning outcome statements with this reading. So it's not all just about calculate what the bond liability will be in the balance sheet. So like I said, this reading pretty much is about accounting for bonds. Now, when we say accounting for bonds, what we mean is bonds issued by a company. So we're talking here about bonds issued by a company, i.e. we're talking about companies borrowing money. So what we're going to do is we're going to have a look at how companies have to account for those liabilities. Now, slightly harder, I think, for the exam is leases. So we'll have a look at in this reading about leases. Now, in particular, there's going to be two types of lease we're going to look at. We're going to look at it from the perspective of the company using the lease. So, for example, a company leasing a photocopier, or leasing the sales director's car, or leasing a building. That's a common one. Then what we're also going to do is we're going to look at it from the point of view of the lessor. Now, the lessor is the company that's actually providing the lease. So essentially a financing company, or someone like Mercedes, who may, rather than sell you a car, lease you a car. So we'll look at how they account for leases as well. Now, right at the end of the chapter, there's a tough little bit on pensions. Pensions is mostly a level 2 topic. I mean, you'll cover it in detail at level 2. So we're only going to have a look at a basic introductory kind of session on, what kind of pensions do companies offer? How should they account for those? So let's get cracking first of all on accounting for bonds. Now, at this point of your studies, you may have looked at accounting, you may have looked at bonds in general in the fixed income section, but probably most of you won't have done. So probably most of you are going to be studying FRA before you have a look at the fixed income readings, and that's perfectly normal. Now, some of you may have come across bonds before, and I think it's important to have a basic understanding of how bonds work so that we can understand exactly how they account for them. Now, in terms of studying this section, a lot of the FRA stuff becomes a lot clearer when you start to revise. So don't worry if when we first go through this material, you need to go back over it again. Normally, second time through, people find it a lot more straightforward and find it a lot clearer. So it's quite normal not to find this particularly intuitive at the start. Because remember, again, what the accountants always do is, we've been mentioning all along, they have a specific set of rules that they follow. So, we have to remember that once you've learnt those rules, it becomes a lot easier to understand what's happening in a balance sheet or in the income statement. But up to that point, it can be a bit tricky to understand. So let's just have a think about how it works with a company issuing a bond. So a company identifies that they want to finance themselves. So they want to borrow money via issuing a bond. So for example, we're just going to do some really basic numbers. Let's just say, for example, here, we've got company A. And what company A is going to do is they're going to issue a bond. And we'll say that they issue the bond to the market. So they're going to issue that to institutions like pension funds, and that'll be done via, normally those pension funds will buy them via their brokers, or it could be hedge funds, it could even be individuals that may buy the bond. Okay, now in return, of course, when they issue the bond, what the company does is it promises to do two things. The company says, so let's imagine, just to keep the numbers really straightforward, let's say the company issues a bond for, and in total it issues a bond for, let's say, $10 million. So it issues that bond, so in return it will receive proceeds of $10 million. Now, how do we know what the company issues the bond for? Well, we're going to show you a calculation in a moment. Essentially, the bond proceeds are the present values of all of the cash flows that the company promises to pay. So company A promises to do two things. It promises, first of all, over the life of the bond to pay coupons. So over the life of the bond, the company is going to pay a coupon. And that coupon rate will vary depending potentially on how the market wants the bond structured. It will also depend on what current kind of coupon rates are that companies of a similar risk may be paying. Now, also as well, the company promises as well to pay at maturity. So they pay at maturity what we call the par value. So we're going to say here that this company's par value happens to be 10 million. So just to keep the numbers nice and straightforward, I'll show you some simple numbers in a moment with some different numbers and stuff. But just to keep the numbers nice and straightforward at the moment, we're going to say the par value, okay, of this bond is 10 million. So at maturity, they're going to repay the par value. Now, in the UK, we call the par value the nominal value. So they're going to repay that 10 million. And that maturity might be in, let's say, 10 years' time. So the company will determine how long a period over which they want to borrow. And the market may have some input into that as well. So we can see there's effectively two things that the market or our investors in this debt are receiving. They're receiving the coupons and the par value. So what we need to do is we're going to need, when we look at bond accounting, we're going to need to look at two things. We're going to need to look at the liability in the balance sheet. So that's going to value that bond and work out what the company effectively owes on it. And then what we're also going to do is we're also going to have to calculate the interest expense in the income statement. Now this is the bit that's a bit trickier actually, because the good thing about the liability is the calculator is going to calculate that for you. The interest expense, the calculator will calculate it for you, but it's important that we do actually try and understand what's happening with the interest expense. So in this instance here, the interest expense is going to be very, very straightforward. It's just going to be whatever the coupon is. And the coupon will just be a percentage times par value each year. Now, why is that the case? Well, because the bond is issued at par. So in that instance then, what we're going to learn when we do fixed income is the total return on the bond is called the yield. So when a company borrows money, the borrowing cost for the company is called the yield, which in turn is the total return for the investor. Now, when a bond is issued at par, so when a bond is issued at par, then in that instance then the coupon and the yield will be the same. So for example, let's say the company is required to pay 6% a year total return to its investors, the coupon would also be 6%. So when bonds are issued at par, the accounting in terms of the expense will be very, very straightforward. In that instance then, the interest expense will be equal to the yield, which in turn will be equal to the coupon. What we're going to find is that's true when the bond is issued at par. But when the bond is issued for more than par, so if it's issued for proceeds that exceed par, we say the bond is issued at a premium. Okay? When it's issued for proceeds that are less than par, we say it's issued at a discount. Now in that instance then, that's when this relationship breaks down. So this relationship there will break down at that point. At that point, the interest expense will not be the same as the coupon. In that instance then, what we're going to have to do is account for the premium and the discount. And that's really what this reading is about showing you. To be honest, accounting for bonds issued at par is going to be very, very straightforward. What we'll just see is the interest expense will be equal to the coupon, and we'll show the liability, which will be the par value. It's much harder when you have bonds issued at a premium or a discount, and that's what we're going to have a look at really now. So what we need to do is we need to just understand what the accountants call this. They call this the kind of effective rate method. That's because, as far as they're concerned, the expense that they show in the income statement is the effective expense. This is what we would call the effective expense. Here is the yield. So what they do is they take into account the coupon, but they also take into account any premium or discount on issue, and we'll come on to that in a moment. So just to summarise then, what we would find then is when the company issues, so it issues the bond for 10 million, the accounting would be cash up 10 million, and then what they would show in, remember our par value here is 10, isn't it? So let's just remind ourselves of that, our par value is 10. The liability would also be 10 million there. Now over the life of the bond, the interest expense will be equal to the yield, which will be equal to the coupon. So in that instance then, my interest expense will be the coupons paid each year. Like I say, this isn't going to work. It's not going to be quite straightforward when we have a bond issued at a discount or a premium, which is what we're going to talk you through in a moment. So for example, let's say we had 6% coupon. What we would then do is we'd say, okay, cash down 600,000, okay, and we would show an interest expense of 600,000, and that's what would happen over the life of the bond. At the end of the bond's life, they would repay the 10 million par value and then remove the liability. So like I say, when bonds are issued at par, accounting for bonds is very, very straightforward indeed. It's when they're not issued at par that we have the problems, that when we need to do a bit more work, and that's what we're going to run through now. Right then, so let's have a look, just make sure we're okay with the terminology. We just quickly recap. Okay, par value then, that's the amount repaid at maturity date, that's set out up front. The coupons are calculated as the par value times by the coupon rate. The maturity is the date at which the par value is repaid. The underlying reading only covers really basic vanilla, or what we call conventional or straight bonds. It doesn't go into any of the more complex ones. That's been removed a few years ago when they rewrote the reading. The sales or issue proceeds, these are the present value of all the future cash flow payments using the effective interest rate or the yield to calculate it. We can do that. We can calculate the present values on the calculator as we've learned in quant. So we'll go over that. I'll show you some examples.